This is Amit Pabari, founder and managing director of CR Forex. In today's presentation, we are going to discuss about what is the outlook for dollar rupee pair for the coming week and what is the strategy for exporter and importer. Let me start with the first part of the presentation, that what is the outlook for dollar rupee pair for the coming week. On the positive side, we have inflows in the form of IPO. In the coming week, there are 4 IPOs which are lined up, which are expected to raise 10,000 crore from the market, because of which we may see some FII inflow coming in next few weeks. But the most important part is what is the RBI stance. We have seen that last week also there were inflows lined up, but RBI has been absorbing all of them. Last week also they have bought close to 74.10 levels. Second positive factor is falling crude oil price. We have seen that crude oil prices have been falling from last couple of weeks, which is supporting the dollar rupee pair. On the negative side, we have strong US economic data. Most of the economic data in US are coming absolutely rock solid. Last week we have seen that they have given strongest service PMI data since 2005. On last Friday, non-farm payroll data came, which was superb. Unemployment rate has been falling and wages are increasing across all the sector. Good economic data and most of the Fed members turning hawkish for the interest rate will definitely take DXY towards 93.5 level and 95.5 level. If dollar index moves to 93.5 and 95.5 level, definitely it will keep pressure on dollar rupee pair. On the domestic side, weak data story continues. RBI clearly said in the monetary policy that they are revising downward growth for Q3 and Q4, and they are expecting the inflation to rise in the entire year. On the outlook front, we expect dollar rupee pair to take support between 74 to 74.20 levels for coming days. The pair has an important resistance at 74.40 level. Once the pair breaks that level, then the pair can move towards 74.80 to 74.90 in near term, and on the medium term we expect the pair to move towards 75.30 to 75.50 levels. Thin margin exporters like agri exporter or chemical exporter, they must have taken orders last week between 74 to 74.20 levels. We advise them to hold with a stop loss of 74.10 for a target of 74.40 and 74.80 levels. Thick margin exporters like textile exporters or pharma exporters, we advise them to hold with a stop loss of 74.10 with a target of 74.80 to 74.90 levels. They should not increase the hedge ratio more than 50% at any point of time for the next 2 months. For importers, as the biasness of the pair is on the weaker side and the premiums are lower in the near term, we request all the importers to hedge for at least 45 days payment between 74.10 to 74.20 levels. If any importers want to wait, they can keep a stop loss of 74.45 levels. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे.